All right, so let's talk about something I know a lot of you have been through. You find a great trading system, like the gap reversal, you study it, you see the potential, it looks amazing, and then, in practice, it just doesn't work out. The results are just a bunch of frustrating, inconsistent trades. Sound familiar? Yeah, it's a story pretty much every trader has lived through. So what gives? Why do these awesome-looking trading systems seem to just fall apart when so many people try to use them? Is there some kind of secret? Is there a magic formula that you're just not getting? Well, let's get right to it. The truth? It's probably not the system. Nope. More often than not, the system is perfectly fine. The real problem, the breakdown, happens with us. It's all about the execution, those little mistakes we make over and over that completely sabotage an otherwise winning strategy. So that's what we're going to do today. We're going to tear down the 6 biggest mistakes, the absolute success killers that traders make. Think of it like a checklist, right? A way to make sure you're not the one getting in your own way. All right, let's jump in with number 1. And honestly, this is a huge one. It's a fundamental mistake that trips people up before they even get close to placing a trade. And here it is, forcing trades in a sideways market. I mean, think about it. A system like the gap reversal is built for markets that are moving. It needs a trend. Trying to use it when the market is just chopping back and forth, well, it's like trying to sail a boat when there's absolutely zero wind. You're just not going to go anywhere. And you can see it so clearly here. On the left, that's the mistake. You see the price just bouncing around, going nowhere fast. That line, the 9-period exponential moving average, or 9 EMA, it's just a simple tool that shows us the short-term trend. And it is totally flat. Trading in this kind of environment, it's a recipe for getting whipsawed and faked out. Now, look at the right. The fix is simple, but man, it takes discipline. You just wait. You wait for a clear trend before the gap even happens. You let the market show its hand first. Okay, on to mistake number 2. This is where we start talking about developing a professional's eye. Because you have to understand this. Not all trade signals are the same. Not even close. So you see the price touch a key level, and your first instinct is to just jump in, right? That's the trap. The big mistake here is ignoring the quality of the signal candle itself. Look, pros are selective, they're picky, they aren't just looking for any setup. They're hunting for the A+, top-tier ones. So what makes a signal A+? Well, this shows it perfectly. We're looking for those big, obvious rejection wicks. You know, those long tails on the candle? That's the market screaming that it tried to push in one direction and got slammed back. Then you want to see the body of that candle close with real strength in the opposite direction. It's like a visual confirmation that the power has officially shifted. All right, mistake number 3. So you've got the right market conditions, you've got a killer signal, but you can still mess it up right at the entry. And this one is all about how you manage your risk. This one's a classic rookie move, using a totally arbitrary stop loss. You know, just picking a random number like, I'll risk 20 pips, or I'll set my stop at 0.5%. The problem is, that number has nothing to do with what the chart is actually telling you. You're completely disconnecting your risk from the trade idea itself. Here's the key. Let the setup tell you where to put your stop. It's so simple and logical. If you're going long, your stop goes just a little bit below the low of that beautiful rejection candle you found. If you're going short, it goes just above the high. That's it. This gives the trade the breathing room it needs to actually work out. Okay, let's talk about mistake number 4. And I'm not going to lie, this one is a straight-up account killer. We're moving beyond simple technical slip-ups and into a huge psychological and financial trap. And it is over-leveraging on a single trade. Come on, we've all been there. The setup looks like a sure thing, it's perfect, and you get that voice in your head telling you to go big, to really make a killing on this one. But let's be real, that's not trading. That's just gambling. And this really drives the point home. Look at the difference. A pro thinks in the long term. They know trading is a numbers game, so they risk a tiny, manageable amount on each trade, like 0.5% to 1%. Why? So they can easily survive a string of losses, which, by the way, will happen. The gambler? They're risking 3, 5, 10% trying to hit a home run. Just 2 or 3 bad trades in a row, and their account is toast. And really, let that sink in for a second. It's not just about the money you lose. A massive drawdown absolutely crushes your confidence. It messes with your head, and it makes it almost impossible to think clearly and make good decisions on the next trade. All right, on to number 5. This mistake is all about tunnel vision. It's about forgetting to zoom out and see what's really going on, which is ignoring the higher time frame context. It's so easy to do, right? You're staring at your 30-minute chart, you see a setup, and you're so focused on it that you don't realize you're about to trade straight into a massive wall of resistance on the daily chart. It's the classic can't see the forest for the trees problem. But the fix is so easy. Before you even think about taking that trade on the 30-minute chart, just take 10 seconds. Literally, that's all it takes. And flip over to the daily or the 4-hour chart. Just ask yourself, am I buying right underneath a huge resistance level? Am I trying to short right into major support? That one simple check will save you from a world of pain. And that brings us to our final mistake, number 6. And this one has zero to do with your charts or your indicators. This one is all about you and knowing when to say enough is enough. The mistake is not having a daily or weekly loss limit. We've all done it. You take a couple of losses and suddenly it's personal. The emotions flare up and all you can think about is, I gotta get my money back. And that's when you start revenge trading, taking dumb, impulsive trades just to feel like you're in control. But it never, ever works out. The market couldn't care less about your feelings. So, there you have it, the 6 biggest ways traders shoot themselves in the foot. But fixing these isn't about just memorizing a bunch of rules. It's about a complete mindset shift, from thinking like an amateur to executing like a pro. It's about having a professional playbook. And here's that playbook, all laid out. It's pretty straightforward, isn't it? Only trade in clear trends, be super picky about your signals, use stops that actually make sense, manage your risk like your career depends on it, because it does. Always check the bigger picture, and have a hard stop for when you're done for the day. This, right here, is your roadmap from frustration to mastery. Because at the end of the day, it all boils down to this. The system works, it has an edge. The only question is, will you? Will you execute it with the discipline it deserves? So take a good look at this list. Which one? Which single mistake are you going to focus on and eliminate from your trading starting today?